quickly pull up something like Marico as well. It's in focus after the company delivered their Q2 earnings, and honestly, largely quite a decent quarter for the company to say the least. Almost a 30% growth that they've shown in revenue. EBITDA as well subsequently saw an impact in this quarter. The management highlighted that was under pressure due to higher input cost prices, which impacted margins, as well as higher investments in advertising and promotion as well.
While we are looking at margin contraction also, that was something which was already penciled in by the street, that there's going to be pressure on account of these raw material costs also which are there. But overall, a positive stance is what we are seeing. In fact, the company delivered a strong top line is what we are seeing, with margins remaining under pressure due to these higher input costs and all that. But our colleague Mahima caught up with Saugata Gupta, the MD and CEO of Marico, to understand company's expectations for the second half. So let's listen into that.
My first question to you is with regards to where volume growth is concerned, because this time it came in at around that 7% mark versus that of 9% earlier. Slight downtick there, but overall it has outperformed the way peers have done, right, in the FMCG staple space. Just want to get a sense as to what is leading to this kind of volume growth and outperforming the peers.
I think a couple of things, if I had alluded to earlier, is that I think we have been, consistently able to anticipate risks and convert them into opportunities, whether it's in the diversification agenda, whether in the distribution of protection of general trade through our Setu. And I think there's been a significant amount of institutionalized resilience. And today's world, resilience is a very, very critical thing. And ability to, for example, I think very few places in the world where you get 100% input cost increase, you take a 60% increase in your power brand pricing and still deliver volume growth. Although Parachute has been transactionally flat, but I think this would have impacted significantly. And if we look at historically, ever since the COVID ended, there has been not a single quarter, in spite of significant adversity, including inflation and other things, we have ever have a surprise on our bottom line growth. We have delivered consistently EBITDA positive growth. So I think the diversification agenda is playing out well. Recently, value-added hair oils growth, for repivoting towards focusing on category building, fundamental brand equity building, as opposed to trade spends, in spite of the fact that there has been competitive headwinds at the bottom of pyramid, and a very, very solid, resilient international business. So I think it's been a factor of all three. And I think obviously we have also invested significantly in the last 4-5 years in leadership development from within, and it's a very, very experienced and tenured leadership.
I agree completely, Mr. Gupta. So, getting a sense of volume growth, there has been, recovery in the entire space, right, in terms of where FMCG stands on the back of a lower base as well, of course. But Q1, we saw a slight recovery. Q2 also, we've seen volume recover. Since you've been already doing high single digits, do you think that early double digit is possible by the end of FY26 in terms of volume growth?
Very difficult to get, because it's also is a function of how the input prices play out, especially in Parachute. Having said that, I think if you ask me this quarter, the entire sector faced some transient headwinds during September, during the GST transition, but the entire GST, this entire whatever has happened in GST has been transformational, extremely bold step by the government. Long term, it will drive accessibility and affordability, and it will drive definitely better growth in the sector. I think sector growth is expected to improve, a function of overall demand as well as anniversarization of a low base. And we expect our volume growth to be a tad better in the second half of the year than what it was in Q2.
Okay. With regards to your food business, that's seen a consistent growth of anywhere between 20 to 25% over the past few quarters, and it's been very impressive where the food growth is concerned. This quarter, it's slightly moderate, and I understand that this might be on account of one GST, and if at all there's some other reason, you can give us an explanation towards that. But in terms of a recovery with regards to this food business from the 12% mark, do you think there was a one-off which has happened this quarter? Do you expect the recovery soon in Q3, or how does it pan out?
I think I must say that I have set high benchmarks, because a 12% is not seen as good, which is good for us, I think.
Absolutely.
I think we are extremely confident of getting it back on 25% back.
Yeah.
And 2-3 things have happened. One, I think there was obviously some transient issues. Secondly, As you know that we are just integrating True Elements, and last year was the last year of earnout of a founder, and then we are getting the business, repivoting the business a bit, focusing far more on profitability and break even. Similarly on Plix also, we are the Plix nutraceutical part of the business, we are focusing on break even, which has happened. The break even has happened, and getting into mid to high single digit EBITDA growth in the next 2 quarters. So there's a focus of both profitability. So it's a little bit of a small pause, I would say, for 1 or 2 quarters. Similarly, in Saffola, we are rejigging the portfolio to focus on a few things. Our learning is, if you look at our oats, masala oats franchise at a scale level, it makes company level EBITDA. So our entire mantra for foods is, especially for Saffola, is fewer, bigger, better, and relevant. And therefore, having done all this, we are extremely confident to get the food growth back into the 20s sometime in Q4 and well into the next year.
Understood. With regards to your EBITDA margin, because you've said that there will be improvement FY27 onwards, just want to get a sense of what range is something that you're aiming at, because I understand that copra prices have kind of moderated and have been benign. What's the outlook like?
So it's still high in the sense that copra prices have gone down 15 to 16% from its peak. The next crop will come around March, and the current outlook suggests that the crop is good. And therefore, as the season comes in, there will be a correction in prices, definitely sometime in March. So what we believe is, while second half will be better than first half, and we are reasonably confident of delivering double-digit EBITDA growth, as far as next year is concerned, we will strive to deliver at least a 200 bips improvement in the margin and ensure that over a 2-year CAGR, it's still double-digit.
Interesting. Okay, copra prices, you said that the coming crop is expected to be a good one. Just want to get a sense as to that, pricing compared to where it was last quarter. Do you think there will be some change in terms of where, the pricing is concerned, some reversal in terms of pricing grammage will take place, or no, that will not be the case?
No, absolutely. I think wherever required, I think at the end of the day, we operate in emerging markets. Our job is to ensure to protect volume and market share. And whenever there could be opportunity, we'll pass it on to the consumer to provide value. For us, as I said, driving value to the consumer and protecting market share and volume is paramount importance. Margins has always come.
Value-added hair oils has been growing in high teens. Do you think this can reach early 20s? Again, setting your expectations higher. Do you think this can reach early 20s maybe by the end of FY26 or maybe early in FY27?
I think our first endeavor is to consistently deliver this, teens growth and a double-digit growth. I think it is, as you know, the portfolio struggled quite a bit, and the reason is not only internal, external. We faced, I think, what I call irrational competition, especially at the bottom of pyramid. A lot of money was taken away from above the line to below the line. We decided to repivot sometime 3 quarters ago, because as a market leader, it is our job to invest behind category growth, long-term equity building of brands. That is delivering the results. And I think first let us settle down and then we'll see. But I think for us, if I can deliver double-digit, consistent growth, value growth, and the fact that growing, and as you know, that this part of the business where we are focusing on makes high margin, it will not only lead to better value growth, it also lead to better mix and therefore margin improvement over the medium term.
Understood. Okay. One last question to you, Mr. Gupta. 10,800 plus crores is what you did in FY25. First half, you've already done over that 608 crore mark. Where do you see the top line going by the end of FY26?
So I think we hope to end with a 25% kind of a number, around that 25%. That will at least definitely accelerate our ambition to hit the 20,000 mark in the next 5 years, because in the first year we do a 25% growth, delivering a 11-12% CAGR for the balance 4 years becomes easier.
Okay, well, that was the management of Marico Limited in focus. The stock currently up over 3% in trade. While the management does remain confident on its target of about 25% growth in this financial year, he also expects a double-digit growth for margins going forward as well. Mr. Chokalingam, let me come to you on Marico. Now, the first half, we did see that impact of raw material prices playing into the margins as well. But it's the next half that we'll be focusing in terms of improvement or recovery in this particular area. Just want to get your overall perspective on this talk.
Certainly, it's a great management for last 6-7 years. Consistently, there has been growth, though the annual year-on-year growth rate has been fluctuating. There is no doubt that it's a growth stock. and also return ratios are too good, no doubt about it. And also third, whenever the margin slipped below 20%, they were able to pull it back quite successfully. The only areas of concern is that, in the last 3 years, profit growth is only 10%, and Q2 the margins have come down almost 400 basis point, and stock is trading at 59 times. So, which I believe, quite difficult to justify on the basis of the latest performance. So, still considering the past performance, at best, I would give a hold rating and look for any, effort in improving the margin back to 20%, as management has indicated. Also, around 14% revenue growth to reach about 20,000 crore revenue in 5 years. So if these things can start showing some signs, then this can become a good buy. Otherwise, right now, I would give at best a hold recommendation.